Okay, so we are live. Hello, everyone. Welcome to today's episode number 3, How to Pick Winning Stocks. On today, it has a very interesting discussion. We have Michelle Marki from channel Michelle Marki. We have Steve from Disruptive Wealth Creation, and we have Manos from Money, Whiskey, and Coffee. That's always an interesting name, Money, Whiskey, and Coffee. And I am Kaye from Invest for Tomorrow with Kaye. So what I'll do is I will open the floor for a quick introduction and we'll go through the room. And Michelle, why don't we start with you first?
Well, thank you. And I appreciate that you welcome me on the channel. And I'm all about investing. I learned how to invest like Warren Buffett, and I'm striving to try to be the best investor I can be doing that. So I don't want to take up too much time. We'll get into that some more, but feel free if our fellow YouTubers would also like to introduce themselves.
Steve, you want to start next?
Yes. So my channel is called Disruptive Wealth Creation, and it's all about disruption, about opportunities in making money when there's disruption. So all my stocks that I invest in are all growth stocks. So, they vary from things like to do with biotechnology to robotics to sort of Tesla, all that kind of stuff. And as well as that, I also do a lot of crypto, which I do enjoy as well. Okay.
Manos.
Hi, I'm Manos from Money, Whiskey, and Coffee. My channel is about investments, personal finance. I do cover disruptive stocks as well, the same as Steve. I have more of an emphasis in 3D printing and automotive stocks. I also do cover some crypto, even though that's not my area of expertise. And I also do ETFs.
Awesome. And hello, everyone. My name is Kaye. My channel is Invest for Tomorrow with Kaye. The main purpose is to create awareness and education and create awareness among people so that they can start investing. So it doesn't matter. I cover ETFs and stocks. I do share my own public portfolio on how to invest. I also have dabbled into options because that's something I've been doing for a while now. So that's pretty much it. And then my goal is to bring awareness through these discussions from fellow YouTubers on how they invest and learn from them. So with that out the way, introductions, let's quickly start off with some quick questions. And one of the basic questions we have is, how did we start our investing journey? Because I guess as new investors, they always like to know, how do you start investing and what triggered you? What made you start investing? What made you think about investing? So we'll start off with the folks over here on the call. Michelle, if you want to take that first question, and then we'll go through the room accordingly.
Sure, thank you. So when I started investing, I was a teenager, and I was fortunate to have older cousins who knew how to invest because they learned from their father, who had invested during the years leading up to the .com bubble bursting. So I learned a lot of lessons from my cousins and uncle about how stocks can behave and how you can also make a lot of money and lose a lot of money at the same time. And I thought it was awesome that they taught me about things like a Roth IRA, and I'm sure you have something comparable in the UK of a tax advantage retirement investing account. And a Roth IRA, I think, is amazing because we can have post-tax contributions to it and be able to grow our earnings in that tax-free. So to me, that was one of the most exciting things that helped me to get really interested in investing, is the fact that there was a lot of upside to being able to grow my money beyond the interest rates and bank account. So that was my main start as a teenager in investing. And I want to save some for which exact stocks I started out with. And I want to welcome others to share their beginning story in stocks.
Steve, you want to take the next stage?
Sure, yeah. Well, the strange thing about me is that when I started investing, it wasn't in shares. When I was in my 20s, I started investing in property. And I know that most people, they start with shares, make some money, and then they go into property. And I kind of did it the other way. And that was only because my parents invested in property. So I then sort of started investing in property. I had a financial advisor, so I had these ETFs and things, but they took care of everything. And then when I kind of retired a few years ago, I thought to myself, I've got the time. I don't need a financial advisor. I'm going to do the research. So for the last few years, I've been doing just shares. I don't do ETFs. I don't do any of these index things. Just straight on shares, and that's all I do.
Awesome.
Manos, how about you?
Well, I'm kind of a product of the dot-com bubble and the first financial, not the first, the 2008 financial crash. So I had a really negative disposition about the stock market and investing in general. But during the second lockdown here in the UK, I was so bored out of my mind that I started looking at it a bit more. A bit more. Was looking into it a bit more. Like, okay, what is it? What's a stocks and shares ISA, which is the Roth IRA equivalent? And when the whole GameStop thing happened, I said, well, I'm gonna try and make some money out of that. I made some money. I thought I was the best. Then I lost that money with my next pick, and then I said, okay, I'm gonna do it properly now. So I started doing all the research, and I did find a lot of bad actors in the space promising silly returns and things. So that's why I started this channel as well, to try to educate people a bit. And the more you know, the less you are about to be scammed, really. So
just as a disclaimer for the audience, did you invest in GME? GME, yes, GameStop.
yeah, I did. I didn't make a lot. I made like £200, but I kind of lost it in my next pick, which was a penny stock. I don't even remember now. But
okay,
yeah.
so that brings up a very good question. So in my case, I have been my parents have been investing. So I have seen them as active investors since I was a child. So I kind of knew that I wanted to get into investing. So my mom and dad, they both were very active in the investment, daily investment, basically. I won't call them day traders, but they were actively investing on a day-to-day basis. So I kind of grew up watching them invest, and I had this. My dad used to give me, my pocket money for the month and say, try to see if you can, double it or triple it. So I did a lot of. I didn't invest in that, but I tried to, sell things online. I tried to, sell CDs and DVDs back when I was a kid. So I did a lot of side hustles, and that I kind of, started getting into that investing. But my proper investment began when I started maybe 10 years ago, 10, 12 years ago. That's when I really started investing. And that kind of brings up our next question. Do you consider yourself as an active investor, or do you consider yourself as a passive investor? Open for anybody who wants to take that pick.
Well, I'm most definitely an active investor. So I used to do the passive investing when I didn't really know better in my early 20s. And even though I own some stocks, I read this book, I Will Teach You to Be Rich by Ramit Sethi. And I thought that was a pretty neat book. And I was like, well, might as well jump into a bunch of index funds, because how can you go wrong? And that worked out okay for a while, because this was also in the years after the Great Recession, and it worked out okay. But as soon as I realized a few years ago, I had this big awakening to start learning how to invest like Warren Buffett around 2017. And then shortly thereafter, I promptly sold all of my index funds and ETFs and haven't looked back since. So I'm all about actively investing in stocks now.
Right. So myself, if by active do you mean I look at my shares every day, the answer is yes. In terms of trading, no, I look for opportunities. If I'm honest with you, within the last few weeks, although I've got a sort of a decent portfolio of shares, I've been doing a lot of crypto recently, and I think the reason for that is because I have a feeling that at some point, like, people keep saying the stock market's going to crash, and I'm thinking, why do I want to buy shares now? So I'm kind of spending more of my time on crypto. So that's me.
Got it. I would say that I'm both. Half of my portfolio is index funds and ETFs, and I keep adding to it each month, and I don't really worry about it. I have specific ETFs that I want to, which give me an exposure to the world, and specific industrial sectors as well that I want to be part of. And then the other half of my portfolio is individual shares, which I'm a bit more active into it. I do my research, I add companies into my portfolio, I remove some other companies, but it's not on a daily basis. I do it like twice a month, let's say. So it's not exactly active, it's semi-active.
So before I answer that question, just a kind of an offshoot on that question. Any of you do swing trading? Do you do day trading, swing trading, any of those activities?
No.
Okay. So you consider yourself as an investor and not as a trader then?
Yeah,
definitely.
I mean, yeah, and it's funny when you put it as active versus passive. Like when I say active, I'm always studying stocks, and if I might buy some, it might be a long time in between when I'm able to actually buy the stocks. But that's to me still considered active because I'm doing the research and homework before I buy something, as opposed to like my understanding of passive is just that you're in index funds essentially, and something that you don't have to actively keep track of yourself because someone else is doing the managing. Whereas like trading can be like in the definition of a lot of people who do trading, that's like hyperactive in terms of like a lot of people monitoring the minute by minute movements of some of their positions. So I'm definitely not a trader, definitely as much as I would like to believe a long-term investor.
Awesome. So I kind of fall depending upon which portfolio I'm looking at, I will fall into a different category. So I do have different portfolios. So I generally have a long-term portfolio where I would consider myself as an active investor to begin with, because I pretty much look at my portfolio on a daily basis, not that I'm making any transactions, but I do make plans on a weekly basis on whether I'm going to add more to my long-term portfolio or whether I'm going to add or remove something from my, swing trading portfolio. So I have become a little bit more I have moved towards the trading side, moving to the dark side, I guess. So and that when we get to the next questions, I'll explain why and how I select stocks. But that was a great one. Now, I kind of got some answers that some folks do not use ETFs or index funds, and I know Manos, you said you have some index funds. Do you also invest in commodities, forex, and I know Steve, you invest in crypto? Michelle, how about you? Do you invest in other alternative investments?
Not really. So the funny thing is, I mean, maybe as far as alternative investments, if you can count certain collectibles, then maybe, but I consider those like childhood hobbies that I just have left over and that I don't put too much thought into. Like I'm pretty sure I could sell my Pokemon cards for a certain profit by now, but I don't really consider that much of an investment. So like I actually, it's funny you mentioned that because I just did a video on what are the 5 main asset classes that I'm releasing today at 6 p.m. And I included a little bit of what could be considered alternative assets, and things that you just mentioned seem to fall into that category. And I'm curious about if Manos and Steve, if you guys are into futures or commodities trading or anything like that.
Personally, not at the moment. The only thing I would say, if I was going to add to what I've already said, is that I'm looking actually, and this is I'm being active, and I've been active for 2 weeks, but I've not pulled the trigger or done this yet. But I'm looking at getting some NFTs. So that's going to be interesting when it happens.
Are you going to get a whale NFT?
To be honest with you, there's a very good video which I will share with people if they want. But one thing that I came across, which was very fascinating, was a lot of people were very clever and smart, because obviously we know crypto's kind of come on the scene, and people sort of started buying these sort of websites like crypto.com, and they had no intention of getting involved in anything to do with crypto, but they just bought them and then hang on to them for a couple of weeks, and then when the thing kind of blew up, they sold them for sort of hundreds of thousands of pounds. And there's all sorts of things going off in the crypto sector, and because it's evolving and because it's new and because a lot of people haven't jumped on the bandwagon, this is where this disruption, it's an opportunity of possibly making some decent bucks.
So for our audience, can you kind of give a brief on what NFT is?
Right. It's a non-fungible something or other.
Non-fungible token.
Tokens, that's correct. Yeah. So I think that the best way I would describe it, although this probably isn't the correct definitive way, it's like a digital attachment. So, but it's protected on the blockchain. And I don't really want to get too involved in it, but the long and the short of it is you're the only person that's got it, and it's great because if you were living in a house and God forbid there was a fire and you had to run out of that house, the only thing that you need to take is your mobile phone. Don't bother about the oil painting on the wall or the chandelier, because you've got that NFT on your mobile and you can just sell it at a later date and get your money back.
Got it. So that's very interesting. Manos, do you have any alternative investments apart from crypto?
I do have crypto, but it's like 5% of my total portfolio. It's not a lot. And I don't have any holdings on commodities, even though I do really want to invest in physical gold and physical silver and physical palladium as well. But that's more like in the future. I don't have anything like that. And I definitely don't have NFTs because I really don't understand why I would pay a lot of money for a JPEG, which I can right click on my browser and save it, and I have a perfect copy of it. So,
quick question on the on your the desire to own some physical type of commodities. How would you actually buy the actual kind and store it somewhere physically, like in a storage?
No,
box?
it's gonna be through some sort of broker. There is an interesting platform called Kinesis now. It's Australian based. I haven't taken the step forward to put some money into the platform, even though I have an account. But they have a tokenized version of gold and silver. So they do have physical assets, physical gold, physical silver in storage places, and you buy a token like a crypto token, which has a direct backing in physical gold and physical silver. But I haven't tried the platform, so I can't recommend it at the moment.
I was going to say, how do you know it's legit? Like anyone
They
could
do.
claim. They
Yeah,
could claim
true,
they have the
true.
warehouses, right?
I definitely agree. However, they are audited by some big auditing houses, and basically those auditors go in and say, okay, you claim to have X amount of golden bars. Where are they? And they go and they physically count them and check them, and they issue a report saying, yeah, they claim they have that many. Yes, that's what they do. Unlike Tether, the stable coin, which they don't have the money they claim to have.
Okay, so that's great. I think from my perspective, I did own a few ETFs for commodities back in the days, but I got out of that. Wasn't much interesting, not much used to move in gold and silver prices. Okay, so I guess this is the one of the most exciting questions which we're going to talk through. Is we're going to talk about your thought process on how you pick stocks. Now, since all of you have said that you do have stocks in your portfolio and some have ETFs as well, Michelle, let's start with you, because I know you're a big Warren Buffett, Charlie Munger fan, and your channel is based on that. Why don't you walk us through your thought process on how do you select stocks? How do you decide whether you want to buy it at this point in time or a future point in time? I just want to get your thought process, and then we'll go through the room with Steve, Manos, and then I'll share my experience.
All right, yeah, and this could be really long-winded, so I'm not going to get too into the nitty-gritty, but essentially, going based on what Charlie Munger has said, there are 4 key principles to keep in mind, and the main one is that a company has meaning to us, and that we're capable of understanding it, that they have a durable competitive advantage known as a moat, and that they have management that has integrity and talent, and that we could buy it at a margin of safety price, or a price that's reasonable and ideally on sale. And you can see I can recite that from memory just because I'm trying to live that through and through. And this boils out to exploring different kinds of stocks that I may have already been enjoying their products and services. Like, let's say I enjoy Starbucks coffee and I happen to work there. So it's natural that I would have owned it as an employee when I worked there in my teenage years and early 20s, because it was something I was living and breathing, and it was just there in front of me. So it's like, why not invest in something that seems to be, growing? And as a business, Starbucks had been growing tremendously. And lately, I also did a little bit of a valuation check on Starbucks lately, and I feel like it hasn't been expanding as much as maybe in the past in terms of what it's currently doing, and it's taking on more debt and seems to be not bringing in as much earnings or free cash flow to offset some of that. So it's helpful to look into the financials and check, would I still buy this company now, and is it worth buying it at current prices, or should I wait for an event to come around that might drop it in prices? Like, a lot of people thought that with the pandemic, people would stop going to somewhere like Starbucks and Dunkin' Donuts, but I'm pretty sure people are still addicted to coffee. So in spite of, everything going on with what in the last year and change, it doesn't stop people from still wanting to get their daily coffee fix. So if I wanted to buy Starbucks, I would think about, is this something that's on sale? And do I think it still has the fundamentals in terms of its financials and also its durable competitive advantage as a business? And that's how I would try to go from there and evaluate if it makes sense for me to buy now or at a time in the future.
Now, Michelle, do you use any specific techniques for evaluating a stock, or is it more looking at the balance sheet and projecting the future growth?
When you say techniques, I mean, I go through a certain methodology that I learned from Danielle Town and Phil Town from their Invested book and from other materials that they've put online that are free to a lot of people and their Invested podcast. And I go through a few kinds of valuation calculations that we do go through the balance sheets and cash flow statement and income statement to pull the certain financial figures and do some number crunching. And then we arrive at a price that we think could be reasonable based on what we think could be the growth projections of the earnings per share in the future and perhaps the future growth rate of the company. So some of that is finessed. Like, I have to be kind of guesstimating what I think will be the company's growth rates. So I'm curious if you had other things in mind in terms of techniques.
One of the techniques is basically looking at the chart price and then kind of doing a technical analysis on seeing whether this particular price of whether this particular price of the stock is something you would get in at this point in time, or would you wait for it for the next support or the resistance, something on those lines.
Oh, like, so kind of like if it's oversold or
yes,
overbought
oversold or overbought territory. Yes,
and MACD, like some of those, I mean, it can be helpful. Like if you see something's already at 40% kind of oversold, like it could still go down from there. So maybe it's a little bit better to buy it at like a oversold rating of 1 on the slow stochastic. Like, I mean, some of that could help you when you're kind of ready to maybe pull the trigger and buying it on which specific day, if you're kind of like getting close. But if we think about it as sort of like a fishing expedition, like you're kind of surveying the ocean as to which fish you might want to catch. And then maybe you bust out some of the more technical indicators when you found a good patch where you think you can grab a big net of fish. And then maybe at that point in time, you get all into the science of the technicalities and logistics of actually getting it done. But when it's like you're just kind of surveying and keeping in mind in generalities what you think a stock price could be good for you, I kind of try to stay at the more higher level and not get too into the specific technicals until I'm ready to spear a fish in this analogy.
Wow, that's amazing. Now, just last question from what you just mentioned. How long do you generally put your stocks on a watch list before you try to hunt the fish?
Well, I mean, some of them are just sitting on my wish list and they've been on them for years. So I actually think a lot of stocks have been overpriced for years. So they just sit on a spreadsheet and I leave them there until they eventually maybe come to a point in time when they could be on sale.
Awesome. All right. Any questions for Michelle before we jump on to Steve?
No.
All right, Steve. What about your thought process? Share your thought process with us.
Right. So mine's kind of less technical. I mean, the first thing I look at is the CEO of the company. So, I want a company that has got some sort of competitive advantage or edge. And Michelle's already mentioned the moat, so I won't go into that again. But I like a company with a good CEO, I like to have a look at their mission statement, see what they're all about, see what they're trying to achieve. I'm always interested to know what institutions that are already investing. So, it might be something like BlackRock, or, whether it's another company. I want to see who else is investing in this company, who else believes in it. I obviously look at the financial statement. I look at the last 12 months. I look at the last quarter. Obviously, look at things like gross profit, revenue, dividends, price earnings ratio. I mean, a lot of the companies that I invest in are growth stock companies, so they don't have the PE on them. Something like Spotify, for example. I'm also always interested in what the pundits, what people like Jim Cramer from Mad Money, or ARK Invest, sort of Kathy Wood, or all these different people, what they're saying about the company, to get a more objective view, because I feel that they've got more resources, and they're actually in the thick of it. They're in that financial world, in that bubble. So I do actually take a lot on board of what they might say. So that's how I kind of look at judging and deciding which company to choose.
And same question to you, Steve. How long does it take for you to put a stock on your watch list and actually pull a trigger?
Well, what I do is, like Michelle, I have a lot of companies that are on there, and they just sit there, and then one day I have that eureka moment or that light bulb moment, and I go and get it. But I'm aware and always looking and remembering and thinking about it. Because I mean, for example, biotech companies, they have so much hurdles to get through, regulations, and the same with mining companies, all these environmental issues. These things can drag on for years. So it's just getting the right timing.
Okay. Any questions for Steve? Okay.
Yeah, actually, I want to ask, so when it gets a little bit more into, say, some of the math behind some of the growth companies, are there any ones that you might like to look at? Like, some people like to look at the last 5 years of price to earnings growth ratios and things like that. So I was just curious if you use any numeric way to sort of ascertain. Like, some people also use sales figures or multiples of sales. Like, what might be something that helps you on a more quantitative basis?
I think for me, it's probably looking at how much debt they have. Are they able to pay the interest on a yearly basis? And if they can, if they've got enough cash flow to maybe meet 3 years, that I'm happy, because a lot of the companies that I invest in are tech stock companies, and we know that tech stock companies don't do well when there's inflation and the economy is not doing well. So the debt is one of my major concerns.
Great.
Right, thanks.
Great. Manos, what about your thought process?
Well, my thought process, I'm a numbers guy just because of the nature of the work I'm doing. So I definitely look at the financials. I definitely look at their PE ratio. Is it something silly like 600, or is it something which is ideally less than 20, or something which is reasonable? I definitely look at their earnings per share. I look at the history. Have they beat expectations? I definitely look at some more qualitative stuff, especially in companies that are in my area of work. So what are their competitive advantages? Do they have a technology that their competitors don't have? And is it really something that people want to buy from them? So those are all things that I definitely look at. I do look at what Steve said. Are there institutional investors investing in those companies? Even though that's a bit misleading sometimes, because if a company is an S&P 500 company, for example, you're definitely going to have BlackRock, definitely going to have Vanguard, definitely going to have Invesco in there, even though they might not believe in that company, but they have to, because it's an S&P 500 company, so their ETFs have holdings on that company. I do read the news about the company as well. I do read the analyst reports, even though it's not like analysts have been wrong in the past, and I don't really look at the CEOs, because I generally don't trust CEOs.
I like them.
I don't like them because they're going to say whatever in order to pump up the stock, keep the shareholders happy. And yeah, I don't want someone stroking my ears, really. I want to make a decision on a company based on what they're offering. Can I understand what they're offering? First of all, if I don't understand what the company does, then I don't have any reason to go into that company. That's why probably I haven't invested in biotech companies. I'm not very versed in biotechnology, so I wouldn't know if company A has a competitive advantage over company B. But if you're telling me about 3D printing companies, okay, what's the difference between Stratasys and Desktop Metal? Do you have 3 hours? I can analyze everything you want. But yeah, definitely look at the financials. I'm one step before doing a full DCF. I am looking at their financials. I want to see debt, as Steve said. Do they have debt? And if they do have debt, why are they taking on debt? Are they taking on debt to pay dividends? I'm out immediately. Are they taking on debt in order to invest in R&D? Okay, I can live with that, but how much debt are they taking? Can they pay it off if they have to? Are they sitting on a lot of cash? How are they leveraging their debt? So all those things are important for me as well.
Got it. And same question, Manos, is there like a time frame you have within when you put a stock on a watch list versus when you pull the trigger?
Oh, well, I have a lot of companies on my watch list that I've kind of missed the boat, let's say, but hey, I'm fine with that. I mean, the stock market is always going to be there, so you might miss one stock. There's another one down the line, so you don't really need to be scared and buy something which is expensive, because at the end of the day, when you're buying a stock, you're buying their future earnings. You don't have to pay a lot for their future earnings. You have to pay a fair price for it, and if you miss that fair price, well, that's fine. There are 10,000 companies in the stock market, at least in the US stock market. Then there is a UK stock market for us. There's a European market. So there you go. You have tons of options.
So you have a lot of fishes in the pond, I guess. Then.
Yeah.
Okay. All right. I think a lot of what you have said is pretty similar. I guess I'll dumb it down, considering we don't want to go too technical. I basically create a watch list on the type of stocks. Generally, I don't invest in stocks which I don't understand. So for me, if I want to invest in a stock, I'll first go to their website. I'll try to understand their products and services. That's how I begin. If I don't understand their products and services, there is no way I will invest. So that's one of the reasons I don't invest in biotech or healthcare stocks, because generally I don't understand that and I try to stay away. Now, when I have to do a research on the stock, I will first pull out their earnings report. I look at their 10K, I look at their most recent quarterly earnings, and I'll also see how they have performed in the past 5 years. Now, I generally go by the stock price because I create my own, support and resistance levels, and I see at what point of time I will enter. Once I have put those figures together, I basically create an alert, and once the price hits that point, I pull the trigger. So again, there is no specific time. It's basically driven by the movement of the price chart, because now I'm mostly trying to trade as a trader. So that's how I trade my investment. Now, I do have a long-term portfolio where I have certain stocks. So I'll give you like Apple and Amazon. I don't have to think about. I just do a dollar cost average on those. I've been investing for like over 10 years in them, so not much is going to change. But yes, let's say, for example, if you have new growth internet stocks, like for example, I opened a position in Pinterest. Generally, when I'm starting off, if I really am not able to figure it out, I generally start with a very, very, very small position. And let's say I always come in a mind that if I have to invest $1,000, I will never invest $1,000 in one go. I generally have tranches I build. So at different prices, I will say, okay, if a stock price is at this level, I will, deploy 25% of my capital, and then so on and so forth. And if I miss the boat, I miss the boat. Then that stock will remain at that level. I will not deploy the additional cash. So I'm not very technical, I guess, when it comes to the dollar, the DCF analysis or certain those analysis, because I mostly deploy my cash based on the chart movement of the stock. So that's
Awesome.
how.
And Mask, what apps or programs do you use for your price alerts when something might be at the price you want it to get at?
So generally, I have a Fidelity, so I use the Fidelity alert options, and I do use the software from the Fidelity directly, the Active Trader platform on the desktop. But I have started using Webull these days, where they also have an alert which pops up directly on your laptop as a pop-up window. Those are the two tools basically I use.
Do you use any for your phone, or does anyone?
Yeah,
Out of
all
curiosity?
the apps are on my phone. Yes, all the apps are on my phone. So.
Okay, yeah, I've been trying to figure out what might be a good useful one because there's so many, but sometimes they don't quite seem to do what I would expect. Like if I put some stocks on a watch list, then sometimes they're not really able to give me an alert when it hits a certain price. I was just curious if anyone has found success there.
No, it's a delayed response. Even the price will hit, because most of the days I'm able to track the price, so I know that it hit at this point in time. But the alert came out like few minutes later. So sometimes you will miss. So what generally my technique is, let's say if I decide to enter at $50, I would actually put a limit order at $50 and just good till canceled. That way, whenever the stock hits, my 25% cash flow will be deployed at $50 until that order executes.
Right, and I will say that's a good idea. I also try to do tranches when I'm putting a position on and not put all of whatever I'm going to invest in all at once. Like that was actually one of my mistakes in the past, is I would just be so eager to just get it over with. And now I'm better about putting in tranches, like usually 25% at a time.
Awesome. There was one interesting question, which is kind of an offshoot from this question, is when you're making a decision to buy a stock, if a company is issuing dividends or buying back those shares, does that take any how do I say, is that a decision making point for you to buy back or not buy back that share? I mean, to purchase or not purchase that share?
Right, and with that question, back in the day when I didn't know what I was doing with investing, I used to look for things like dividends, and like I made the mistake of buying something like Verizon and ExxonMobil just because it had dividends, and these stocks went like nowhere for like whatever months I held onto them, and I like was just going for the dividend. So I feel like just buying based on the dividends was not satisfying to me. And I know a lot of people like buying dividend issuing stocks, and that's fine. But I kind of feel like I wasn't invested in those stocks for the right reasons. Like I didn't really care about Verizon or Exxon that much. I was only going for the numeric dividend. So that was like not the right way to approach it. But on the flip side, if a good company that I believe in is buying back its shares at a price that makes sense, then that's awesome. Like if there's nothing better to buy, like Buffett has been slightly buying back Berkshire Hathaway because I guess he doesn't feel like there's better bargains out there. So he feels like maybe Berkshire Hathaway could be worth more in its intrinsic value. So it makes sense that he would be buying back a little bit, but he probably doesn't want to overdo it in case like it's maybe not the best bargain right now, and to try to hold out for some better offering with his over $140 billion that he could deploy. So it to me, buying back shares is only good if it is a reasonable price at which to buy back the shares. But if it's like super overpriced, like the PE ratio is out of control and they're buying back aggressively, and meanwhile the inside ownership is selling a lot of shares, to me that's a little bit of a warning sign in that maybe they're not investing in the company for the long term. If the company is buying back its shares at prices that are overvalued, but yet the inside ownership is selling off its shares. So, you have to look at what are some of the inner workings going on with why they could be motivated to buy back shares. So I like buying back shares if it is the right price.
I think for me, I agree with everything Michelle has said, but because I'm into growth stocks, if a company's buying back its shares, I think, well, hang on, you should be investing that money, so that is a warning sign for me. But I must admit, if a company does buy back the shares and it's paying off, I don't know, some sort of capital debt or something, well, for me, that's not bad. I can live with that. So that's my take on the buybacks. In terms of sort of the dividends, they don't mean anything to me. You know, if a company's doing well, I'd rather invest the money in the company rather than share out the dividends. But obviously, if the dividends are going down, possibly that might be a warning sign as well. So that's my take on it.
Manos?
Yeah, so dividends, that's an interesting one. Dividends for me are a source of passive income that I want to build for the future. So at the moment, I am building a dividend portfolio. However, I am trying to find companies that can actually afford their dividend, and it makes sense for them to pay dividends. So if a company chooses to pay dividend other than growing or paying off their debt or investing in R&D, then that's not a company that I would like to be invested in. A dividend needs to be something that's a reward to the shareholders if everything goes well. However, we have the dividend aristocrats, and I'm pretty sure if one of those companies say, okay, this year we're not paying a dividend, all hell is going to break loose because shareholders, myself included, we are kind of spoiled in this sense. But if a company doesn't pay dividend, then you're buying it, and you know in the back of your head that you might say, yeah, I'm going to keep it for 10 years, but eventually you're going to sell it because you are going to need that money. So it's the other side of the argument. So with a dividend portfolio, you might say that yes, I have a lot of money in there, but it's paying me enough each month, so I don't have to sell it. But if a company doesn't pay dividends, then at some point in your life you will have to sell it. So it's not a clear-cut answer. There is a company in the UK, Vodafone, for example. They choose to pay a ridiculous amount of dividend rather than paying off their debt or investing in better customer services. And everybody who has Vodafone is telling that no, it's the worst company ever. But they're paying dividends. So I don't see the point. And that's why I'm not investing in Vodafone to begin with, even though their dividend is quite okay. But in terms of share buybacks, I will agree with what Michelle said, that, yeah, why are they buying shares back? Even though, in general, again, that's a way to reward your investors, people that have been with the company for a while. That is a way of rewarding them, especially if there are no dividend payments. And the flip side of the argument is companies that are issuing shares like there's no tomorrow, and they're diluting your position. Tesla. Like, so I don't get that either. Yeah, I mean, share buybacks are good. It's not the end all be all for me.
Can I ask a question?
Yeah, go ahead, Steve.
So when you get your dividend, do you reinvest it in the company that gave you the dividend, or do you use that money and buy something else?
Depends, really.
Okay.
Yeah.
So
But
now,
it could be either. It could be
Okay.
it could be that it's reinvested in the same company into other companies, or take the dividend and, I don't know, buy something or pay a plane ticket to go somewhere.
Yeah.
Really depends. It's passive income, so you can do whatever you want with it.
Okay.
so I'll also take a stab on that answer. So now, because we are mostly a personal finance channel, and generally if you're a new investor, or if you have if you don't need that money, it was always ideal to use the drip option. So that way, when you get the dividend, you just reinvest that. You can invest in other as well, but definitely if you don't need that money, it's always ideal to invest that. That's just a tip or a trick.
Yeah.
You can take it as you like. From my standpoint, I think if it's a dividend portfolio where I'm buying a stock, of course that stock needs to pay a dividend, because why would I keep a stock in a dividend portfolio if it's not paying a dividend? So and the same logic applies. I would not buy a stock which is paying dividend, and I'm seeing that they are not paying off their debt, and I only purchase stocks from a dividend portfolio if they are, I understand their products and services. So end of the day, I think whether I'm choosing a growth portfolio or dividend portfolio, I look at what the company is doing. So for example, let's say I'm a big fan of McDonald's. I don't like their food, but the business model, and what they're doing, and because it's not just a food company, it's also a real estate company, right? The next one would be Michelle probably loves Coca-Cola because it's Warren Buffett. I am on the Pepsi side because I just like their products. I like Coke more as a product than Pepsi, but I guess I like Pepsi from as a company in general, because I have understood their business model a little bit better than Coca-Cola. So those are the companies I will choose. Now, if they're buying back a share, I'm more concerned if they're diluting the share, unless it's like a company like AMC or Tesla. It makes sense. It's a meme stock and one is a hyper growth stock. But generally those, they don't play. I'm very cautious when the dividend yield is very high, because if the dividend yield is very high, which means that for me, the company is only focusing on dividends. And if they're not generating enough revenue for the company to grow, because I don't want the stock price to be stuck 10 years at the same price while I'm getting, a few dollars in dividends every quarter. And whereas I would prefer a smaller dividend payout, but they are reinvesting more money into their company, paying off debt. And so that is my logic in the dividend and buyback standpoint.
Right. Yeah. And Kay, I totally agree. I've gone so far on this direction that I would rather the company not give me any dividends if it can better invest it in the company's future growth. So something like Berkshire Hathaway has done exactly that. And I only wish I could have existed in the 1960s or 70s to be able to buy Berkshire back then, because I mean, if it was at $8 in 1962 and grew to $430,000, I'm okay with not getting dividends for anybody who invested in Berkshire at that price. And that, yeah, totally. I'm with you on that. Like, I still have a stock that gives me dividends, which is Starbucks. But to your question about if it's reinvested, I actually don't reinvest my dividend money from Starbucks into anything. Like, I mean, maybe I should have, but I never thought about it that way. And I just took the cash and put it in something else. And like the thing with dividends is I don't like getting taxed with it. And I realize that both I get taxed and then also the company is getting taxed on dividends. So if they can better invest it in the company and not issue it as dividends, I think it's a better situation. And that's why I tend to favor either reinvest it as the management into the company or do share buybacks. But like right now, I'm more with Buffett in terms of not wanting to get dividends if I don't need it, or it doesn't really, it's not something that I intrinsically look for in the company when I'm evaluating it. And also, I'm actually pretty neutral when it comes to soft drinks. So I'm neither for or against Coca-Cola and Pepsi, because I tend to just drink plain water or tea or coffee. So I try to have less sugar in my life.
That's amazing. So we are moving a little bit on the health side of the discussion. So since we just talked about a few companies, let's ask what are some stocks that have been your winning stocks and you're proud of, and then we'll also talk about the flip side as well. So Michelle, why don't you take this as?
So probably I keep mentioning that this was like a fluke that I happened to invest in Starbucks, but that has been my best holding since I was a teenager. And like the interesting thing is I've just held that for years. So I that was my best performer so far.
Steve?
Right, my the stocks that I'm proud of are the ones that I really like, that I invest in, are basically three car companies that are all electric, which are Tesla, NIO, and XPeng. So they're my best three ones.
Manos?
I have two stocks that I'm quite proud of, even though I didn't have large positions in them. One is EX1, which is a 3D printing company, and I was about to sell actually because it wasn't going that well, but then the news came out that it's going to be bought by Desktop Metal, and for each share you're going to get $25 equivalent, either as cash or as Desktop Metal shares. So I'm holding on to that now, and that's a gain out of nowhere, I guess. So yeah, that's a bit of a fluke. The other one is a European stock, a French stock called Dassault Systems, and
Yes.
I bought that. I bought that in the French stock exchange. I didn't buy the one traded in the US stock exchange. I bought 2 shares when it was pretty expensive, and now they went through a stock split, and now the stocks are on a 10% gain at the moment. So yeah, I'm quite happy with that. I didn't know that they were going through a stock split when I bought them. They announced it a few months after I bought the stock. So yeah, quite happy with that.
Great. And for me, I think there are 2 stocks. One of the stocks, Leroy and Steve would not agree with, but it has been Apple, and the second would be Amazon. Michelle, I don't know if you know, but we had a conversation last month as well on this particular topic, which would be one stock if you could own, and I chose Apple, and Steve was. Steve is not a big proponent of Apple, so we always have a little bit of a laugh when we talk about Apple.
Yeah, what happened was Kaye then went on to do his own video, and he called it One Trick Pony, because this was what it was all about. I just basically said that there's no innovation since Steve Jobs died, unfortunately, and all they're doing is hanging on to the iPhone and gobbling up all these other companies. But anyway, that's a story for another day.
I actually want to say I love that you still have owned Apple, and I heard a little bit of some of those videos, and I think you said you've owned Apple since 2008.
Yes.
So I think that was a job well done, because it's obviously been on a tear since then. And I actually would love to own some Apple if it's on sale at some point. Like, I in retrospect, like I've been using an iPhone for the last decade. So I kind of regret that I was kind of like not into Apple. Like I grew up using Windows computers, PCs, and had been able to make custom parts of a desktop. Like I think Manos also talked about, you could spec out at a lot cheaper than Apple. So I'm not like so into Apple computers per se. Like I'd rather have a Windows computer, like that's what I use, but I do my video editing with a MacBook and Final Cut Pro. So to me that works out pretty okay, because sometimes you still get the blue screen of death with a Windows computer. So that's not fun if your Windows doesn't like, doing certain high processing power activities. But like in using an iPhone, like I feel like to me, it's just been more convenient than going with Android. So I've been pretty content with that. And I actually still use an iPod that's from 2008. So like, I feel like I wish I could have invested like you did in Apple, but I'm actually not that into Amazon. So I don't know how the others feel about Amazon, but I'm totally into eBay. Like I'd rather do eBay all day if I don't have to buy something from Amazon.
So interestingly, on Amazon, I would be publishing a video on Amazon, and this is more of their most recent changes they are doing, and which is not visible to the naked eye. It's they're replacing all their shipping from FedEx and UPS, not USPS yet, to actually their own carrier. So Amazon has spent billions of dollars in the new Kentucky hub. And so more to come on that. But definitely, if Amazon is not on your watch list, I would highly, highly recommend to keep it on your watch list, because that is another stock analyst missed, because they thought that the price to earnings ratio, the price to sales ratio is too high. We should not be paying for Amazon. And look what happened in the last 10 years for Amazon. Okay, so since we asked
right. I mean, you're right. You picked a great 2 stocks. So I really commend you.
And I also made a mistake. I had Netflix also back in 2011 and 12, but I sold out of Netflix. Ooh. And so I did paper hand in some of those stocks.
It's all right. We've all been there.
Yeah.
So now, since we talked about your winning stocks, what is one or more stocks you have held in your portfolio which you regret? And what lessons have you learned so far? And what would you like to tell our viewers?
Well, I mentioned some of mine, like with some of my dividend stocks that I only invested just because they gave dividends, and I didn't really do my research or homework into them. And back in like a few years ago when I owned things like Exxon and Verizon, their stocks went nowhere. So I was kind of like, why am I owning this if it's not really growing? And like, so there's something to be said. I mean, sometimes some companies have reached a plateau where they only can sort of issue dividends or do a little bit of buybacks, and that's kind of what you can expect out of them. But I wanted to have more of an aggressive stock portfolio and what I would own. So I regretted those two, not because they did anything wrong, but just because I wasn't in it for the right reasons. And also, I briefly owned Facebook, but then I like kind of sold that after a couple of months because I was like, I don't know if I ethically agree with what they're doing. So I kind of just wanted to not be part of something that I might not fully believe in.
Well done. Right, so my company is a company that you've probably not heard of. It's a UK-French company called Nerfomix. And this company is a biotech company. And the biotech company was at the beginning of its journey. And what I liked about it was the stock was very cheap. So when I bought into this company, I had literally thousands of shares. And that was such a feel-good factor. You know, here we are, you know, a company, and I've got thousands and thousands of these shares. But this company, because it was at the beginning of its journey, it wasn't really going anywhere. And then when the CEO left and another one came, and then there was a lot of changes going place, and they had this big promise that this Chinese company was going to get involved, and then they weren't going to get involved. I quickly pulled out, and that was a good lesson for me, because I'd read the spec about, oh, this company is going to be going places, and I hadn't really done my research. So that was a good lesson for me. So yeah.
Manos, how about you?
Well, my biggest regret is buying a SPAC that bought the SPAC that bought Markforged, and since then the price of the resulting share has dropped. I should have waited and bought and buy Markforged to begin with, and this kind of you know, I burned myself there, so I said, okay, no more SPACs. I'm gonna wait. I might pay a bit more to buy the company that results from the merger, but hey, at least I'm not gonna lose any money. So yeah, that's my biggest regret.
Wow. I have a long list of regrets. I don't know where to start off. But the first one, I would say, every single time I have given into FOMO, the fear of missing out, I have made a mistake. Every time I have not invested the way I invested through my own methodology, I have always regretted. And one of them would be Nikola. So that was a SPAC. And a lot of FOMO came during that time. And I guess I was in that, I would say, the everybody was hyper about Nikola, how it's going to replace Tesla, it's the new technology. And that was my mistake of investing in Nikola. Now, so if when you invest in a stock which you know that is not working out, at what point of time do you decide to pull the trigger of either selling off, or do you want to dollar cost average in the hopes of it will recover someday? So I'd like to get some thoughts from you all.
Well, one of the car holdings that I don't want to name them because I just don't want to get too into that nitty gritty, but that one I thought would go somewhere, but it kind of like wasn't being recognized in the market. And I actually for some time sold some calls on it. So I had covered calls. So if it was called away someday, I would be fine with it, but it didn't end up working out that way. And also sometimes I sort of dollar cost average by selling some puts if it was a little bit more on sale. So this was going on for a few years. And then finally when it seemed to kind of like just barely break even. So I had a very tiny profit on that holding. So I stuck it out because I knew that this company wasn't like completely terrible, but at the same time, it like that's how I kind of moved on when I knew it was making decisions that I didn't really agree with in the future of the company. And then I was just fine with not taking a loss, like a very minor profit, because I could have taken a loss. And like if you see the story changing, I feel like that's a signal to me, like I better watch out and start getting out, especially if certain guru investors that I follow are also getting out of the stock. That might be a tip off to me. So those are some of the factors that I keep in mind if the story changes with one of my holdings.
I think for me, and it's something that Manos mentioned, is these IPOs, you know, the big hype, and you know, you want to get in there quick, and then you buy it, it shoots up, and then it crashes. I've been guilty of that. So it's not something that's good. But in terms of stocks that are not performing very well, I'm quite ruthless. I'll just sell it. Put it behind me, because I always look at my portfolio as a whole. And if the whole portfolio is doing well, it doesn't matter that one or two aren't doing well. I just get rid. And I watched a very interesting YouTube video with a guy called Invest with Darren, and he was saying how he usually sells his loss-making ones just before the end of the tax year, and that usually helps him quite a bit. So it's a good thing to bear in mind.
Manos, how about you?
I when I invest in a company, I don't invest for the next 6 months. I invest for the next 6 to 10 years as a minimum. So small variations in the price, short term, don't really matter to me that much. However, if I see that the company is starting to make weird decisions that don't make sense, and they are kind of selling off their competitive advantages just to keep shareholders happy because they demand profits now, then I might start selling even at a loss, because I don't believe in the company anymore. Obviously, all companies can go through rough patches in their financials because of factors that are outside of their control. But if it's through something of their own doing, then I'm out.
Yeah, and I think I agree with all of you. That's pretty much is the case. If the story is changing, I generally as well cut the stock off. Something called tax loss harvesting. That's how, that's the concept we use. So I'd like to keep my losers as well, because that helps me offset some of my taxes on the winners, especially if you are trading. Now, if you're not trading, you're mostly investing, and you're not going to sell off your stock for the next 5-10 years. Of course, I guess you should try to find winners as much as possible. There's another good question I want to say. So in your journey of stock investment, or investing, not stock investment, investing, what are top 1 or 2 lessons that you have learned and you would like to share that with our audience, and even for your future investors, people who haven't started investing and would like to invest? What should they keep in mind before they start the investment journey?
So I recently picked this up from Monish Pabrai, which he got it from Nick Sleep's investing letters. So what I really love is this idea of ask what is the destination of the company, and that will inform how you kind of treat it. So ideally, if I buy companies, I would like to own them forever. Like in my Berkshire Hathaway holding, I don't expect to ever sell that. Like, and the same with my Starbucks holding, even though I wouldn't buy it right now at these prices, like whatever companies that I would invest in now, I plan to own till I'm like 97 years old, like Charlie Munger, if not, into the 100 range. So that's my game plan, is to commit for life if possible. And I think it's really powerful for Monish to have said, ask what the destination is, because he regrets selling some stocks he bought in India around 1995, when he had a little bit of a windfall from selling a portion of his business, and he invested $40,000, and he thought, like, when he got a 100-bagger, that was good enough, like turning $10,000 into $1 million was good enough for him. But he should have not done that, because he said even if some of them didn't work out, some of them that he did pick became like a 500-bagger, and he would have needed to hold it for 26 years to get that kind of outcome. So that's what I would like to just keep in mind, is just hold on forever if possible.
No, that's amazing, because I've kind of heard that story about him as well. I read when one of the Economic Times, his article was posted. Steve, how about you?
So could you repeat that question again? Sorry, because I just wanted to get clarification.
Sure. So the question is what are the 1 or 2 lessons that you have learned throughout your investing journey? And right, what would you like others to know who are currently in the investment journey or haven't started yet? What would the 1 or 2 lessons you would like to share with them?
I think, from my own perspective, I think you have to invest in, like, something that Michelle mentioned, is you've got to invest in a company that you believe in. Because when I invest, I want to make a small contribution. So a lot of my shares are with renewable companies, So I'm thinking in the back of my head about climate change, and I'm thinking, well, what can I do in terms of stopping climate change? Well, I suppose I can invest in companies that are working towards that. So that's my mission. That's my goal. Obviously, I want them to make money at the same time, and that obviously is important as well. So for those reasons, personally, I would never invest in fossil fuel companies because it's not what I believe in. So that's how I work. In terms of people getting into it, I think it's always good if you know somebody, whether it's a family member or a friend who's already investing, to get involved in it. If not, go and see a financial advisor and kind of slowly work your way into it. Maybe start off with a small budget, and if you lose a bit of money, who cares? You've learned something from that experience. So that's kind of my take on that.
Awesome. Manos?
Two things really. One is it's always a good time to start investing, even if you haven't done so already. I do believe that the market is overvalued at the moment. Everything is overpriced. I do believe that. There will be a correction at some point. When? Nobody knows that. If I knew that, I wouldn't be talking to you guys. I would be in my private island now. But nobody knows that. The thing is that the more you put it off, you defer that decision to go in, you are losing, you are missing out. Then the second thing is going to contradict what I said. Don't listen to what people say on the internet. Don't listen to guys like me or what's his name? Hello Kevin or Meet Kevin.
Meet Kevin.
Meet Kevin. Yeah.
The guy running for governor of California.
Yeah,
what could possibly go wrong there? Don't listen to guys on the internet. Don't listen to everybody hyping a company, whichever that company may be. It could be Palantir. I am invested in Palantir. Everybody is hyping Palantir, but I did my research on Palantir and I really like their product. I like what they want to do, even though I don't really like what they do in the defense sector, but okay, fair enough. But I'm looking past the hype, and that's why I don't invest in Tesla, for example. Steve is a huge fan of Tesla, and you as well, Kaye. But I'm not. I'm not going to invest into something because of the hype or because someone on the internet says it's a good idea. You have to make your own decisions. So that's my second take.
Awesome. So before I give my answer, we actually have a question from an audience. Sean asks, do you subscribe to any investment media sources like TipRanks, Wall Street Journal, MarketWatch, Simply Wall Street, etc.? So Michelle, just let us know if you subscribe to any of those.
So I actually not really subscribe to Wall Street Journal, but I read the main page of it every day and just see what's like in general going on. And then if I really want to dive into an article, I go to my local library that has the physical newspaper and I read it for free there. So for the most part, like you can learn so many resources for free online. Like you don't really have to pay for too much stuff. And if you feel like you're getting a lot of value out of something, then maybe. But there's so much that we can learn without having to pay for it.
Steve, how about you?
Yeah, I actually invest in. I have a subscription with Motley Fool, so every month I get 4 hot stocks and 4 cold ones, and and if I want to invest in those, I invest in those. But as well as that, I also keep an eye on ARK Invest because I'm a big fan of Cathie Wood and stuff like that. But just for fun, I also like to sort of watch these YouTube videos of people like Tom Nash and Chicken Genius Singapore and Motivation to Invest. And there's a little plug for them guys. So I'll have to watch them as well to have some fun. Especially Tom Nash, he's crazy. That man is crazy, and I know that Manos watches him as well.
Yeah,
he's a fun guy.
Yeah,
Manos, how about you? Do you?
I don't. I'm not subscribed to anything. I do have 2, because I have 3. Actually, I have 3 email accounts. So I have 3 different accounts with Simply Wall Street, and that gives me 5 free reports. Company reports per month. So I have like 15 free company reports per month that way, and that's more than enough for me. In terms of tip ranks, I have an account with Interactive Brokers, and they give analyst reports from tip ranks if you have an account with them. So I get tip ranks that way, but as a paid membership anywhere, no.
And the same goes for me. I don't actually pay for any particular membership. Depending upon the stock on my watch list, which I want to track, I'll actually scour the internet. So I'll go to Yahoo Finance, Seeking Alpha. Tip ranks is mostly for the price action. And I also have Fidelity. So Fidelity has a very good research section where you can research, and there are a lot of analyst reports in there. But I generally scour through the internet. I don't pay for any particular subscription. Not yet. And I also, YouTube is also a good place to kind of see. And as Manos said, and I'll go back to the question I asked, and I'll give my two responses. First one, I guess it's very important. YouTube has given a platform where you can hear different perspectives from people, right? So on Palantir, for example, you can see the pros and cons. You can hear people who are pros Palantir, people who are against Palantir, and then you make a decision. So I guess that is the first, I would say, lesson learned is if you like Tesla, try to hear who don't like Tesla and hear their opinion why they don't like Tesla. Don't just invest with the hype, and that's what the FOMO is. And second, if you have missed the boat, trust me, I've been investing for a long time. The time will come again. The stock will drop. You will be able to pick the stock up. So don't worry if you miss Tesla at $100 and now it's $900. It will fall. Of course, it will fall in proportion to the current after split. But there is always an entry point. And that's why I guess it's important to kind of also see how the price moves for stocks. And then you can build your own entry point and exit point. Never buy or sell a stock based on, YouTubers are saying or an analyst is saying, because analyst reports or even these media reports are actually kind of funded. I used to work in an investment company, so I have an idea on how that goes. I won't take any names, but generally there are reporters who are part of these, investment firms, and they provide information and their articles are written accordingly. So always keep that in mind, and always make your own, decisions.
For sure. And with some of that too, I mean, for the most part, a lot of the establishment is always going to be bullish because that's good for business. It's very rare for any investment firm to want to be negative or bearish on any particular holding. And we'll see with people like Jeremy Grantham, he's not afraid of putting out what his thoughts are about, the potential for a big downturn because he's no longer actively investing. But you never want to be the person who is being bearish about something, because if it doesn't come to fruition, people will, think that you're just being negative, like a negative Nancy, and then you get kind of made fun of. So it doesn't pay to be negative if you're a professional investor. But, when you're just everyday people who, on YouTube, whether you're taking the for or against side, it's helpful to consider a lot of different perspectives, because at the end of the day, everybody should be making their own decisions like you all talked about. So it's helpful when someone doesn't have a financial stake behind what they're putting out into the world, and that they're just earnestly trying to share their thoughts and research that they did into an entity. And I actually like Seeking Alpha for that reason too, that there's a lot of people who are just doing this, and not because they own the company or they're pumping it for any reason, but they're just trying to, make it in whatever direction their career is going to. But I haven't quite wanted to subscribe to Seeking Alpha. I don't know if anyone's considered. Yeah, I sometimes I'm just happy when I get that little freebie article and it's like, oh, this is your one free article for the month, and I'm like, okay, fine. It's good to consider different perspectives, but everybody ultimately make their own decisions.
Right. It's your own hard-earned money. You're going to invest it. So if you listen to a YouTuber and you invest and you lose, the YouTuber is not going to pay you back. You lost the money or you made the money. So, vice versa. It works both ways. Okay. So I know that we are a little bit over time, but I want to wrap up before, with two last questions. One is, what are the different books or resources you would recommend to the audience for learning, or YouTube or whatever? What are some recommendations for people so they can learn how to pick stocks like you are doing it today?
My favorite is the Invested book by Danielle Town and Phil Town, because it's such a simple way to explain how to get into investing and try to do some valuation calculations of companies and try to figure out a price to which to pay for a company. Like, I feel like when I was younger, I wish I had this book because I didn't know how to value companies. And I think that's a mistake that a lot of people make, is that they just buy a company. They don't really know what price they should be paying is. And I found that that was a tremendous help in helping me understand it in the way that it's in the discipline of how Warren Buffett and Charlie Munger invest. So I felt like when I came across that, this was what made entirely sense to me. So I highly recommend their book. And also they have an Invested podcast, which is totally free. And it is where this investor father, Phil, is teaching his daughter, Danielle, how to invest. And I feel like that's amazing and just awesome that they did this for free for like unknown strangers listening to their podcast. And also, if folks want to check out my YouTube channel, Michelle Marki, I'm a Warren Buffett style investor. I try to go through all of this, and I'm not trying to sell anyone on anything. So I hope that any lessons that I've learned are helpful to folks.
Absolutely, everyone. And the link for everyone's channel is in the description of this video. So please definitely go and show your support, subscribe to everyone. And you can learn different ways, because all four of us are very different type of investors. We have had our own success and failures. But Steve, why don't you share your recommendation for this?
Well, just to add on to, rather than repeat what Michelle has said, if you're interested in sort of growth stocks, I would recommend you watch some videos of people like Chama Palihapitiya, people like obviously Kathy Wood, ARK Invest, and if you were going to go into crypto and stuff like that, then there's people like Michael Saylor. So there's a lot of gurus, these guys out there that invest sort of literally hundreds of millions of pounds or dollars, I should say. So yeah, there's a lot of stuff out there. So there's no excuse. Just go out, look for it. You'll find it.
Manos, how about
in terms of books, I haven't read any investment books myself. However, in terms of resources, there is Seeking Alpha, there's Market Watch. If you want to find out, even if you want to find the EBITDA multiples, there's Equidam, there's Crunchbase, MarketBeat, there's Yahoo Finance, Google Finance. Probably your investment platform has a lot of tools that you might not be aware of. I have 3 investment platforms that have a ton of information that I can't really go through them in a reasonable amount of time. It's more than I even don't pay for, because they're giving it out for free. So there are things to find there. And there are also people that are doing free courses, either through EDX or Coursera, that you can learn how to do your own DCF valuations. Also, there is Sven Karlen, who has a YouTube channel, and he has a PhD in either finance or economics, I don't remember. And he has a free course on how to do what is different for different asset classes. He has a course of how to do how to find intrinsic values. There is also another website called freefinanceclass.com, which I mentioned in our previous live as well, which there is I can't remember the name of that person, but he also has a free course of how to do your own DCF valuations. All of those things are free and easy to access, and you don't have to pay a guru that guarantees you 20% returns per day. Only send me 5 Bitcoin and you'll be grand. So the information is out there, honestly. And obviously there are idiots on YouTube like myself that I might start making videos again at the beginning of October, and I'm covering a few companies here and there.
And you will pump up few stocks.
Yeah, of course.
Okay.
Of course, with my minimal following, I will pump up every stock there is.
Got it. Now, from my side, I think there are a few books which I guess most of you know. Intelligent Investor is one of the books. There's a very interesting book called A Random Walk Down Wall Street. That's a little technical book, so I don't recommend that book for new investors. I think if you have never invested in your life, the one book I would recommend is called The Index Card. It's a very simple book. I guess I think it's maybe 40, 50 pages. It talks about 10 principles in an index form, and it tells you how to invest. And it's primarily focused on investing in index fund, but that's a very good start for somebody who has never invested. Another good book I have is A Beginner's Guide to Stock Market. Those are easy reads. And if you want to get more technical, you can always go with The Intelligent Investor or The Random Walk Down Wall Street. Now, you don't really need to buy these books. You can actually search on Google, and you can probably find a PDF version. Or if you want to YouTube it, somebody has probably done a summary of these books. So that's always a good way to start for folks who don't like reading and just want to listen on a podcast. I'm pretty sure there were podcasts would also be available. So definitely check that out. So I know we are almost at the end of our session. Before we wrap up, any closing thoughts from you? And Michelle, we'll start with you.
Well, thanks so much, Kay. And there was a question that I think we also had. I'm not sure if we exactly covered it, but for beginners, do we recommend investing in individual stocks or index funds? And I'm going to borrow this from Monish Babrai and Warren Buffett, and that if you don't really know what you're doing, index funds are an honorable way to go. And if you don't really want to put too much work and effort into studying individual companies, it's totally okay, because if you're investing in general total market, stock market, index funds, you're betting on the future of, say, the US economy or other like emerging markets, let's say. So you could go that route if you want to do the least amount of effort. But if you want to really get to know your companies and be really specialized in understanding what you're investing in, I would totally recommend doing individual stocks and trying to put a little bit of effort. So if you're up for it, that's what I would do. And again, like I think that there's so much that people could invest in, like whatever you're really passionate about, like we've talked about with Steve, Manos, and Kaye, you got to go for the things that really have meaning to you. And they don't just have to be traditional stocks. They could be anything that people attribute value to. So that's totally fair and well and good. And I hope everyone the best in their journey towards being the best investor they can be.
Thank you, Michelle. Steve?
From my point of view, I would say get yourself a limited budget, maybe a small budget, just something to start off with. I mean, obviously, if you're not sure, if you're not confident, go and see a financial advisor, or maybe go down the index route, which is a good route to start with. But at the end of the day, do your research, gain a bit of confidence, and take action. And that's all I'm going to say.
Awesome. Manos?
Well, I'm going to say do both indexes and individual stocks, because you can't pick winners all the time. You are going to pick some losers, and when you do, your index funds and your ETFs are going to be your cushion. So that's it. And if you want to start with individual stocks, start with things you know. If you're working in the construction industry, what are the major players in your industry? You know those companies. If they are your competitors, so yeah, you know why they're doing better than the company you're working for. Maybe that's a good place to start. Start with things you know and you can understand, and then you can extrapolate that to other sectors that you don't have that much of an experience in.
Awesome. I think all three of you covered what I was supposed to say, but I will still add something to that. I think from choose what you understand. I guess that is, you can go with index fund. There's nothing wrong with that. Michelle said it, Steve said it. If you are starting out, you don't want to put too much effort into it. But I also agree with Manos, because the best way to learn is not by theory. The best way to learn is also use that theory in practice and learn. And the only recommendation I will give is write down your mistakes. So if you made a mistake by a trade or by an investment, write it down, because you will eventually start noticing that you have a long list of mistakes you have done, and then you will not make those mistakes down the road. So just keeping an idea of how many mistakes you have done. So for example, if I FOMO'd into Nikola and I bought Nikola at a very high price point, that was a mistake. I wrote it down. So always write down your mistakes, and trust me, you will make a lot of mistakes. Don't worry about making mistakes. Make as many mistakes as you want, but don't lose a lot of money by making those mistakes. So that's all I have for you today.
Don't bet the house.
don't put the house on sale, right? Don't take mortgage and invest money. And you can go any way you like. You can go index fund, you can go crypto, you can go stocks, but always manage your risk. Risk management is very, very important. So that's all I have for today's collab. Thank you so much, everyone, for joining. This was a very exciting conversation. I really loved having Michelle as our guest speaker. I hope you will join us for future conversations as well. And anything else from anyone? Any closing thoughts before we wrap it up?
I just want to say thank you so much for having me. And it was great learning with all of you too. And I appreciate all of your insights and experiences as well. I think it helps us all be better investors.
Definitely.
Absolutely.
Definitely.
So thank you, everyone. Take care. Bye-bye.
Bye-bye. Bye-bye.